Your sales are up, the dining room is full, but somehow the bank account isn't growing. Where is the money going, and how do you stop the leak? Hi, I'm Margot Bloch, VP of Client Experience at KitchenSync. We help independent restaurant groups turn outdated financials into fast, accurate, actionable insights without adding more work. Running a restaurant is not for the faint of heart. As you know, work is tough and margins are slim. We are in the business of nickels and dimes, so every last cent matters. Most restaurants lose money by not tracking key financial metrics. KitchenSync helps you monitor them before they cut into your profits. Today, I'll walk you through the top 5 financial metrics every restaurant owner should monitor. Number 1, sales. Most owners know their sales by heart, but sometimes they don't pay attention to the key drivers or know what to actually do with the information. This is a really important way to understand what is driving your business. Do servers need to be trained in upselling? Do you want to reconfigure reservations to drive more traffic? How does tracking sales trends and patterns over time help you optimize staffing and purchases and other key decisions in the future? Number 2, COGS, or cost of goods sold. This represents all of the raw ingredients that go into your food and beverage offerings. It also represents one of the top 2 largest expenses in your business. So you need to make sure you are tracking this and you are tracking it by sales category. For example, food, beer, wine, etc. This is huge when it comes to costing dishes, designing your menu mix, negotiating with vendors, and it's highly controllable. So it's really important you understand what's driving this number. Number 3, labor. Depending on the type of restaurant concept, labor probably represents the single largest, if not the second largest after COGS, expense in your restaurant. Again, this is a highly controllable lever, so you want to make sure that you and your managers are actively scheduling according to your labor as a percentage of sales. The key is maintaining the most efficient level of labor while not compromising on customer satisfaction. Number 4, taken together, COGS and labor combine into what we call prime costs. In the restaurant industry, this is arguably a more important metric than gross profit because these 2 expenses are the largest. Managing your prime costs and ensuring they are under a certain threshold, typically 60 to 70% of sales, is critical to ensuring your restaurant is profitable. If you surpass that threshold, it will be extremely difficult to drive any profit in your business. Said another way, for every dollar that a guest spends, roughly 60 to 70 cents goes to prime costs. That leaves you 30 to 40 cents to spend on everything else. Operating supplies, rent, utilities, decor, etc. So this metric is extremely important. Number 5, net income. As you've probably noticed, we work in a tough industry. Our margins are slim. The average restaurant has a net profit margin of somewhere between 5 and 10%. As I said when we started, we are in the business of nickels and dimes, so every last cent matters. Now you can see why tracking these core metrics is so important. If you're a couple points over in any of these categories, it could mean the difference between a profitable or failing restaurant. To recap, the top 5 financial metrics every restaurant owner should monitor are sales, COGS, labor, prime costs, and net income. Don't let hidden financial issues drain your profits. Subscribe for more ways to strengthen your restaurant's bottom line. And if you're ready to see these metrics in real time and take control of your numbers, visit kitchensync.us. Accurate, fast financials can be the difference between surviving and thriving.